Hello, everyone. Welcome to our August webinar here with the Entrust Group and with Neal Bawa of Grocapitus. My name is Jacob, and I'll be your host today for our presentation. Neal, go ahead and move us to the next slide there. All right, so before we get started, just some things that we have to go through before every webinar that we host. The Entrust Group does not provide investment advice or endorse any specific products. So all information or materials being presented today are for educational purposes only, and all parties watching this webinar are encouraged to consult with their attorneys, accountants, and financial advisors before entering any type of investment. Here's a look at the bullet points that'll be covered today in Neal's presentation. And at the end, we will have a Q&A session. So if you have any questions about the material being provided today or of IRAs, investing in real estate in general, please feel free to type those into the question box, and we will answer those at the end of our session today. Some information about myself. My name is Jacob Marchini, and I've been at the Entrust Group for nearly 10 years. In my day-to-day duties, my job is to provide customers with service and support, so assisting with new transactions, opening accounts, and smoothing things over for our clients. And I do have a CISP certification from the Bankers Association of America. Some information about the Entrust Group in general. We are self-directed IRA administrators, which means we keep records for our clients' IRAs of rollovers, contributions, transfers from other IRAs, and as well as the outgoing funds to their investments for income from those investments, liquidation, sales, and other things that are required of an IRA custodian. We have lots of coworkers who have the same sort of CISP certifications as myself. We have $5 billion of assets under management across over 24,000 active investors. The Entrust Group has been in business since 1981, 40 years of service in the industry, and we offer our clients a single point of contact model for interacting with us. So if you have a question about your account and you need to get some answers about it, we do have a person like myself or my manager, Mr. Bill Neville, or any of our coworkers who are your person that you can interact with via email or by phone regarding your account, in addition to our general client services department to handle overflow. And without further ado, I'll turn things over to Mr. Neal Bawa of Grocapitus for the bulk of our presentation.
Thanks so much, Jake. Welcome everyone to the mid-year edition of the Disruptive 2025 Real Estate Trends presentation. This is our most popular presentation. We typically have somewhere between 2,500 and 3,500 people that watch this every year. And you know what's interesting is the first time I presented this was in 2016, so 9 years ago. And guess what? I presented in the San Francisco Bay Area, and one of the people watching my first ever presentation was Jake's boss, Bill Neville. So he watched that presentation, and since then I believe he has watched every single one of the 9 versions. We presented this twice a year for Entrust for the last 6 years. So now notice that when we present this to Entrust in January, obviously we're looking at the new year, we're looking at what happened last year, so we do a snapshot of that, and then we do a mid-year version where we talk about, okay, well, what really changed in the last 6 months. And so it is a new presentation. All of the slides are new. None of these slides existed when I presented in January. Before I get into the presentation, which is very fun and interesting, there's lots of talks about things like tariffs, all the new tax stuff that happened. We're going to be ranking about 50 cities in the United States for real estate investment. Before I do all of the fun stuff, just a little bit about myself. For those of you that still haven't watched me, because I've done this now, 8 or 9 times for Entrust. My name's Neal Bawa. I'm CEO and founder of 2 companies, Grocapitus and Multifamily University. Anna Myers is our COO. And we buy and build large commercial real estate assets, primarily multifamily related assets built to rent. Our portfolio is about 660 million right now. It's down because we sold a lot of assets, 25 properties, 1,200 accredited investors like you. We have, at last count, over 50 Entrust IRA investors that are invested in our projects. This is about a third of our portfolio. So you can see all sorts of different assets in all sorts of different places. You'll see different kinds of assets. There's student housing, there's townhomes, there's large multifamily, there's industrial, there's office, flex, storage, all kinds of assets that we buy and build. Our investors really like us. They believe that their return on investment with us beats their projects with other firms. We don't in an Entrust webinar ever talk about ROIs or return numbers. So if you ask those questions, I won't be able to answer them. But this is just an external comment from a third party that has not been modified. Here's Dr. Pada. He is a seasoned general partner who's actually done many deals himself, both actively and passively. And what really stands out to him is the way that we use data to drive decisions. I am a data scientist, computer science degree, so I use data in everything. And you can see his quote in orange. It says it all. He sees it as a partner with rare clarity, with strong ethics, and that's exactly why he keeps coming back to us. 2 cents from my lawyer, in addition to the caveats that Jake provided regarding IRA companies. Here are my caveats. We're not investment advisors, and this is an educational webinar. All investments provide risk, right? So be aware of your risk tolerance level. You're free to accept or reject the multitude of investment recommendations I'm going to make today. And keep in mind, a recommendation is never a guarantee for successful performance. In terms of recording, I do believe that the Entrust group sends out recordings. So for some reason, if you have to jump off, I believe you'll get a copy of this recording.
That is
All right.
correct.
Awesome. Well, I will get started, right? Well, you may like Trump or you may not like Trump, but you can never say that Trump is boring, right? The kind of horse trading that we're seeing today is a recipe for upheaval and uncertainty and nervousness. And that's what we're seeing the market do. Lenders are feeling it, brokers are feeling it, capital groups are staying on the sidelines because the Trump card is back. This is the part where history really slaps us in the face. Tariffs just jumped to their highest level since 1937. Yes, pre-World War II. So we're now at about a 16% average on imports. It sort of changes every week, but as of this week, we're at 16% average, up from 2.4%. And that's not a ripple. I mean, that's a freight train, right? And yes, inflation has not reacted yet, except for last week. I saw a little blip in inflation. But I urge all investors listening, don't get too comfy. Delayed pass-throughs are real. They are coming. I'm expecting a significant increase in inflation in the coming 30 to 60 days. And you might see that drive up interest rates. And so far, the economy is fairly chill. Job growth was steady at 135K. We did see a change in June, so jobs did dip there. Unemployment is at 4.2%. The inflation overall has actually dipped. Look at this chart on the right here, and you'll notice that inflation was actually higher in January and then sort of started to dip, and now is beginning to go up again, but it's just a tiny increase, right? Keep in mind, these numbers lag, the impact comes later. So if you wait for the CPI to blink, you're actually late. This is actually a time to game plan now because the board is still quiet. If you're close to refinancing a property, close to buying a property, I don't think you should be waiting for lower interest rates because if anything, I don't think rates are going down. You might see a rate cut happen, but that doesn't mean rates will go down. And given that inflation has been muted the first 4 or 5 months of this year, the only thing that could be responsible for this upward movement right there, see this, of the bond market, right? These are the 10-year treasury rates, is that markets are spooked, just like this cat, right? They're just freaking out, right? So the rate, it's dropped a little bit right now. I think it's a little over 4% today. For those you who don't know, both single family and multifamily rates are very deeply tied to the 5-year treasury rate and the 10-year treasury rate. So people like me obsessively track the rate, and we're very unhappy with where the rate is going because this upward trend chart has nothing to do with inflation data in the last 6 months. It has everything to do with a market that's freaked out by tariffs. And it's not just the market that's freaked out, right? It's also the forecasters. So we, for this presentation, gather forecasts from many different sources, half a dozen different sources. Now these same forecasters are cutting their forecasts for annual GDP growth. You see them downward. Remember, 2% is pretty good GDP growth, right? That's where we were in March, right? As of June, that forecast number is now falling to 1.4% for the year. So far, the first 6 months of the year, the economy has actually outperformed that 1.4% number. which means either that this number is bearish and wrong, or the second half is going to look pretty damn bad. And I'm honestly not sure which way it's going to go. All right, so obviously the first trend, tariffs, right? This is a presentation about trends, was all negative. But the second one is really, really awesome. Yes, folks, this is Oprah level tax generosity. New incentives are making a comeback, and and they could supercharge, they are supercharging deal math for all forms of real estate, right? These deductions are just flying off the shelves, just like Oprah, you get one, you get one, you get one. And basically, real estate folks got everything that they wanted out of this tax bill, and also got some that we actually didn't think we could get. My favorite, and the one that's most likely to juice real estate investor returns and get the juices flowing, is bonus depreciation. Yes, bonus depreciation is now back for 5 straight years. As you can see on the screen, the gray bar was showing that bonus depreciation, which was enacted in the 2017 tax bill, it had been going down every year. And now 2025, it's back up to 100%. It stays at 100% until the end of 2029, and that is incredible. There's lots and lots and lots of new people that are going to be buying real estate in the next couple of years because of this bonus depreciation. This is a huge, huge advantage. I cannot overstate the benefits. Also, big win for high income earners, especially if you live in a place like New York, New Jersey, or California. A lot of Entrust customers are in California. The SALT, or state and local tax deduction cap, goes from $10,000, which I hated, to $40,000. So I live in a home in the San Francisco Bay Area, and I'm going to use all of that difference between the 10K and the 40K. So I'm saving somewhere around $10,000 a year in taxes just from the SALT deduction cap that's on the screen. This means it's much easier for home prices to go up in high tax states. It doesn't really make a huge difference in the low tax states. And then on the right side is this very interesting thing called QBI, the qualified business income deduction. It's alive and kicking. 23% write-off on pass-through income. It stays in place. It was there before and was going to go away, but now it stays in place. Translation: high-income real estate pros get a massive write-off. Let's say you earn, a couple $100,000 in net income from some rental portfolio or your syndication fees that qualify as pass-through income under the QBI deduction. You get to write off 23% of that amount before taxes. So that's $46,000 a year shaved off of your taxable income, right? And if you're in the 35% federal tax credit, you're going to save $16,000 a year based just from QBI. All right, on to this interesting one, real estate, the estate tax exclusion boost. This is actually very personal to me because I just did my, my living trust, and they made me change my living trust because of this in a good way. So the estate tax exclusion jumps to $30 million for couples, right? That's real money. And we were thinking this is going to go down because the estate taxes is one of the things that the Democrats have been attacking. They're no longer in power. So now instead of going down, the estate tax exclusion actually goes upwards, 27% up. Real money that you can pass down without Uncle Sam crashing the party. And you can use it to transfer your portfolios to your descendants tax efficiently, and you can lock in the succession values. So if you're thinking generational trust, you're 50 plus, the clock may just have been reset in your favor. All right. So that was all the dense economic analysis stuff and taxes, tariffs. Now I'm going to get into something more interesting, real estate, right? Mortgage rates, home prices, incomes. I'm going to bitch about the growing gap between mortgages and salaries. I'm going to talk about the return of inventory on the single family side. Then I'm going to jump into multifamily. And some of you are here for apartments. We're going to talk about why rent growth is still stalling. We'll talk about shocking growth in occupancy. And then my favorite slide of this presentation, we're going to talk about demand. And finally, we're going to throw in a little bit of commercial real estate distress, and then we'll talk about loan extensions. All right. For all of you single family people out there, these are the updated 30-year mortgage rate predictions for the end of this year. So end of this year, December 31st, right? So this is what all these smart and important people think the rates are going to be at the end of this year. Now on the left side, Fannie Mae continues to be bullish. I think they don't think much of the tariff issue, or maybe they think the economy is going to weaken, which is going to force the Fed to cut rates because today's rate is about 6.7%. So Fannie Mae thinks we're going to go down between now and the end of the year by about 60 basis points or 0.6%. So very bullish. At the other end of the spectrum, on the far right, we have Redfin, which is saying rates are going to be exactly where they are today at the end of the year. No change. So take your pick. I think the real answer might be these dudes in the middle. All right, here's our updated slide on home prices. Now, almost across the board, the smart people out there do seem to think that home prices are going to go up slightly over the next 12 months. Redfin is bearish, right? But they're still only at minus 1%. Now, I'm not so sure about that. And in a few slides, I'm going to tell you why I think we are going to see a decline, and it might be even a little bit bigger than this 1%. So I'm going against the grain. I'm saying I'm on Redfin's side, but I think even they are a little bit too bullish, in my opinion. I'll tell you why. Now, here's the first of two reasons why I think we might see a slight adjustment downward in single-family prices. I just don't think that there are enough people out there who can afford single-family homes. This may not be true in the San Francisco Bay Area with all these AI startups going gangbusters, but for the rest of the US, it's crazy, right? You may have seen this chart, over the years if you've watched my presentation, right? In the last 4 years, right, salaries have gone up by 25% in 4 years, right? Which is pretty good, actually, pretty awesome. But mortgages in the United States have gone up by 110%. That's an absurd number. And a lot of that, of course, is because interest rates have doubled, and then home prices are up about 45 to 50% in that 4-year time frame. So if your salary goes up 25% and your mortgage goes up 110%, how many people are going to qualify? Well, it's not a lot of people, and I can tell you that. So look at the pie chart, right? So actually first look at this green bar, right? So green bar, you can see that the estimated median price for a new home in the US is about $460,000, right? And below that, in the pie chart, you can see that 70% of first-time buyers, they can't even afford 400,000, let alone 460,000. On the right side, you can see that there are now 53 million households in the US that shockingly can only afford a $200,000 home. We're at 460,000 median and rising. Do the math. It's looking horrible for future home ownership in the United States. And I know that people like me have been talking about rising home prices for a long time, so I understand there's a tendency to say, we'll just ignore what Neal's been saying because he's been saying it for a few years, and that time home prices have ticked up slightly. Yeah, but something's changed fundamentally. On the left side here, right, this is about 2020, you can see that home buyers earn about 17% more than renters. 17%, right? Basically, they needed to earn 17% more than renters to qualify. And that was in February 2021, right? Almost a year after COVID. And then it went up to 55% more by Feb 2023. Then 73%, and now 82%. This is new. This has not happened before COVID, right? When we as a homeowner need to earn $116,000 to afford a typical home, and renters only need to earn $64,000, this gap, the biggest gap in history, it makes it very lucrative to be a renter. And home buying just doesn't make any mathematical sense. It only makes emotional sense. And as they say, God is in the details. As it turns out, the situation is actually really, really bad in some cities and not so bad in other cities, right? For example, if you look at Chicago, that's bottom right here, the premium, right, between what you're paying for a home on a monthly basis and what you're paying for rents on a monthly basis is actually not much in Chicago. So it's fairly easy to jump that 20% gap that you see and go become a homeowner. So good for people living in Chicagoland. Now take a look at Vegas, right, at the top. So when you look at Vegas, the median home payment in Vegas versus a 2-bedroom rent is a shockingly difficult number, right? It's almost 150% more. That's the highest in the US, by the way. So it's astonishingly difficult for someone in Vegas to become a homeowner, right? Much easier in Chicago. So same story for this one, Phoenix and Boise, Denver, Austin, Raleigh, Nashville. These are the cities where becoming a homeowner is becoming just about impossible. It's mission impossible, right? This is why if you're a landlord in these cities, it's to your advantage, right? I would not want to be a landlord in Chicago simply because the gap is too small and people can jump across it. I want long-term renters. I want forever renters. And I get a lot less of those in Chicago and a lot more in Vegas, Phoenix, Boise. All right, I'm done with my first argument on why I think home prices are actually going to dip later this year. Here's my second argument. Remember, for years, me and everybody else has been talking about this thing called the lock-in effect. And lock-in effect was that tens of millions of homeowners like me had locked in extremely low interest rates. My interest rate right now is 1.75%. So if I basically sell my home and buy it back the next day, my new interest rate was going to be 6.8%. So my average mortgage is going to jump by $75,000 a year. This means I'm locked in, right? I'm not going anywhere. And lots of people were locked in, but over time that effect loses its momentum and people need to move. Divorces, debts, debts that happen in the family, lots of family reasons, right? Jobs. And so now we're beginning to see the market actually adjust, actually loosen, and a lot more homes are coming into the market. You see this right here? A lot more homes, right? And again, God's in the details, right? I wouldn't want to be selling in Miami right here, right now. Why? Because Miami is a buyer's market, right? So is West Palm Beach. Pretty much all of Florida is a buyer's market, right? So is Austin, because there's a huge numbers of homes that have flooded in the market in the last 6 months. So obviously what you're looking at on the right side are only some cities in the US, right? If you go further down the list, they turn into sellers markets, right? So potentially places that are buyers markets at this point in the US, and maybe you're a buyer. Take a look at these. Now this slide gives you an overall view of the country, not city by city. So you can see what had happened to inventory for single family homes, down, 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 right? So, here, before COVID, we're right around 1.2 million in terms of home inventory. Then COVID happens, we went all the way down to 448,000. That was a crazy, crazy low number, right? That led to incredible increases in prices. And now in May 2025, right here, right, we're basically back to where we were, or almost back to where we were. And what's important is that the projections here in cream show that we're actually heading for a very aggressive increase in inventory over the next 12 to 24 months. If this stays on the same path, you are going to see a very significant number of US markets flip from being sellers markets to buyers market. So my prediction is of a small measurable decline in US home prices in the next 12 to 18 months. Where does it go from there? I don't know. A lot of it depends on whether we have a recession. All right. That was a lot of single family. I'm going to move on to apartments or multifamily, right? A bunch of you now are on the multifamily side, especially people who invest with me. A story there is mostly incredibly good, but then there's an exception or two. Now, firstly, if you look at the monthly rent growth, this tile here is 0.26% per month. So if you multiply that by 12 months, you're looking at rent growth of over 3%. And yay, that's pretty good in the multifamily industry. We love 3% rent growth, right? But if you look at the tile on the right and you look at the last 12 months, that number really sucks because basically 0.7% rent growth of the last 12 months means that rents are not even keeping up with inflation. Inflation's at 2.5%. And historically, over the last 80 years, rents move up faster than inflation. So obviously, we're sliding backwards in the last 12 months. Of course, different regions, you can see here, are doing differently. The Midwest outperforming, so is the Northeast, right? But the South is negative rent growth, so almost negative 1% rent growth. So that's really, really bad. And the West is just sort of sitting there, right? Occupancy is very interesting, right? The Midwest is very highly occupied. So is the Northeast, right? Simply because they don't overbuild. There was no construction of any note in the Midwest and the Northeast in the last 4 years. All of the construction went to the South and a lot of it to the West, right? So there are these areas where there's a ton of inventory. And as a result, we've seen occupancy spike in the Midwest and stay more or less the same in the South and the West. Now, except these numbers are through May. We are now in August. In June, July, well, August numbers are not in yet. So June and July, we saw huge increases in occupancy for the entire country. All regions are gaining occupancy aggressively in the last few months. So very excited about that. Okay, now this is my favorite slide of this presentation. So I'm going to walk you through it, right? Every time I look at this, I really feel great about my business plan to be a landlord. This slide is really showing you these blue bars. You see these blue bars? They represent the US annual demand for apartments, right? And it depends on how many renter households are created, right? So that varies. So if you look at the blue bar, you'll notice that it's higher than at any other time since 2009. This data goes back all the way to 2009. It's higher than at any other time, right? Except for this one quarter in 2021 because money was raining down on us, post-COVID money, right? That's not a good data point. So look at the number of renter households that have been created, right? This is an incredible number, not right? And now I want you to compare that to the number of starts. And those are in green, right? The difference is massive. So you're creating 700,000 renter households a year in this country. You should be then building 700,000 apartments, right? Each household needs an apartment. So far, we've only built 209,000 starts. These are both annualized numbers, right? So I can pretty much guarantee that 18 months from now, we are going to see a huge rent spike in the US. Why 18 months? Well, because this is a delayed effect. It doesn't happen immediately. It takes a while, right? So when demand goes up, it takes a while before rents spike. This is especially true of the south and the west of the US because those areas, even though the demand is through the roof, they've had a huge amount of inventory come in. So they've had no rent growth whatsoever. But now that inventory is getting absorbed and will almost be fully absorbed by the end of this year. So obviously, with that very significant rent spike coming and it's very highly predictable, it makes sense to go out there and buy multifamily. But the challenge is there used to be a big gap, right, between buying in primary markets, LA, San Francisco, Boston, and buying in secondary markets like Austin or Dallas. See that gap in 2018, right? And see that gap today. It's 10 basis points. Essentially, secondary markets, the Phoenixes, the Atlantas, the Dallases, they're now priced exactly the same as the primaries. And that's bad. That's three red lights for me. And that's why I'm now looking at what are known as tertiary markets, like a whole bunch of other investors, right? There's some compression there as well, right? But overall, these tertiary markets, these next level markets, Kansas City, Indianapolis, Reno, these are sort of 500,000 to 2 million person markets, and they're doing really well. There's still a gap between what you would pay in the primaries and secondaries and what you would pay in the tertiaries. So I suggest you consider doing the same. Pick your favorite markets. I'm going to give you a list in about 8 or 9 minutes. All right. Now, a couple things. Many of you are on social media, and on social media, it's very popular to say that commercial real estate is distressed. Nothing around that is true. You could make a case that office real estate is distressed because of the fact that despite the return to office or RTO mandates, offices are still nowhere near the occupancy level that they were. With multifamily, there's a tiny amount of distress, but I can tell you this. I have made 33 offers to buy multifamily properties in the last 12 months. How many of those offers were successful? Zero. I only got into one best and final in 12 months of making offers. That's how good the multifamily market is. It's still a seller's market, but there's some tick up in delinquency rates. But if you're going to basically read the nonsense of the web and think that this distress is spreading or it's getting worse, we're seeing zero evidence of that. In fact, prices for all kind of commercial real estate assets, whether it's industrial or office or multifamily or hotels or retail, have been increasing for the last 2 quarters. Prices are going up. There are a wave of maturity. Some of you have read about this, but the bottom line is that the lenders are doing a great job kicking the can down the road. Almost everybody that needs an extension is getting an extension. This is not 2009. Lenders did something very stupid in 2009. They pulled back millions of these homes, and then the value of those homes went down. Today, lenders are very smart, and they're basically offering extensions to buyers, as many extensions as possible. So to summarize, I don't think, and I go back and forth on this, but at the moment, I don't think it's a good time to buy single family because single family prices did not course correct at all during the last 2 bad years of 2023 and 2024. Single family prices are about 40% higher than they were in 2022 before interest rates started going up. On the other hand, multifamily is about 25% to 30% cheaper than the 2022 peak. So our summary is while rates probably won't fall this year, they might tick up a little, the incredible boost from the tax bill is driving up prices for apartments and other real estate, commercial real estate. Remember, the rent to buy ratio is massively in favor of renting. We're creating an incredible number of renter households, the best ever increases in rental household demand in the US. So that's your key trigger. The rest is up to you. All right. We finish our presentation with a city by city shootout. I know lots of you are here just for that, so let's get started. We always start with U-Haul, and you've seen this slide for the last 10 years, and the winner this year was very surprising to me, guys. I've been watching this, tracking this for 10 years. South Carolina beat Texas in terms of migration. And in some ways it makes sense because Texas is becoming more expensive. People want to migrate to inexpensive states. Florida and North Carolina, as you can see them in the list, are pretty much where they were. Texas moved down a level. But the most important statistic on this slide is not South Carolina. It is Indiana. Indiana is up 27 spots in a year to number 8, the first time it's ever made the top 10, and it's moving at an astonishing speed. So keep an eye on Indiana. This particular slide deck shows top new home sales markets for 2025. The one that I'm pretty fond of is Cincinnati. I think Cincinnati is actually, not a high growth city, so pretty much keeps its population, doesn't go up or down. But I think that it's a hot market because it's an inexpensive market. You can buy new homes in Cincinnati for under $300,000. So take a look at this, but that's only for new homes. Now, this one is much more interesting to me. I love this because our favorite city ranking group is Milken Institute. Over the last 10 years, our projections for best cities have often matched that of Milken. But I have to say that we usually come in 1 year before them. They're a very large organization, very conservative. For example, their pick for City of the Year at the top, you can see it, is Raleigh, North Carolina. Now, for those of you that watched my Entrust presentation last year, you noticed that our pick of the city for last year was Raleigh, North Carolina. We've also picked Austin in the past before they did. Now, the most interesting city in this list is Ogden, Utah. So if you don't know about Ogden, definitely take a look at Ogden. I also really, really like the Northwest Arkansas area. So one of the cities in this area is number 7 on the list. That's Fayetteville. So fantastic area, incredible growth. I like Benton better than Fayetteville, but it's the same area. So check out Northwest Arkansas. Incredible growth. Here's a list of best performing small cities from Milken, smaller cities. So these are cities that are typically 150,000 people or lower. Once again, we've also in the past picked both St. George, Utah, and Idaho Falls in the last 3 or 4 years in our ranking, the one that we present to Entrust every year. So it's wonderful to see them at number 2 and number 3. Those are the two that I recommend you look into if you're looking to invest in rentals. Here's Zillow's list. They have Buffalo repeating at number 1. Buffalo was number 1 last year as well. What's exciting to me is to see Indianapolis at number 2. We've been talking about Indy for a while. It was our internal runner-up last year as the best up-and-coming city. It's also great to see Kansas City at number 8. So it doesn't quite have the momentum of Indy, but both cities are doing extremely well compared to the past 10 years. All right. And now the last list, all of those previous lists were single family. This is actually the multifamily list for those that like apartments. What do I like here? I really like Vegas. So this market is changing. Just like Phoenix changed after the Great Recession into a broader market, we are seeing that change happen with Vegas, right? It's gaining all kinds of jobs. It's actually losing gambling jobs. It's losing tourism jobs. But overall, there's a gain in jobs in Vegas as the market diversifies. So strong thumbs up. All right. It's my tradition to finish this presentation with me sticking my neck out, making 2 predictions. I pick both the best up and coming market in the US, and those typically tend to be smaller markets that I think have lots of potentials. And then I pick what I consider to be the best market for real estate investment in the entire country in 2025. Are you ready? All right. Our pick for best up and coming market is Las Vegas. This is the first time we've featured Las Vegas in the last 11 years, but the numbers are just too good. There are so many good numbers, but we chose to highlight just one. Population growth over the last 3 years in Vegas has been 4.5 times faster than the national average. Even Texas doesn't see that kind of growth. There's just a lot going on in Vegas beyond the casinos, beyond the tourism. So enthusiastic, 2 thumbs up as the best up and coming market in the US. And now, drum roll, our pick for the best market in the United States for 2025 is, no surprise, Indianapolis. We could have picked Vegas. They're both big markets, but we picked Indy because we're seeing a higher quality of job growth in Indianapolis. We're seeing significant institutional interest, maybe because Vegas doesn't have a good name, right? We're seeing strong rent growth. We're seeing very little supply. There's just a lot of reasons why Indy is a terrific market for both single family and multifamily. Now, if you're looking in Indy, don't look everywhere in Indy. There's a lot of very sketchy, high crime places. Look at Fishers, Indiana. So that's northeast of Indianapolis. If you're looking at single family, look at Carmel, Indiana. So Carmel, these are part of the Indy metro, right? But I'm sort of directing you to the part of Indy metro where the growth is. So I'd like to say I'm very pleased to finally have a city in the Midwest be our best city in the U.S. First time that's ever happened. So go Midwest. But I highly recommend that for those of you that are looking to get into rentals and you want to buy ourselves, you don't want to invest with groups like us, to look at both Vegas and Indy. They're both terrific. So a lot of people here might think, okay, how do we come up with our list of cities? I don't just want a list of cities. I want to figure out how you do it, right? What is the methodology? What's the process? For those of you that are into those kinds of things, we have a data-driven guide that we use to rank 323 cities in the US every year. You can scan the code. There's no call to action. We have no subscription. We don't sell education. So this is just something for you to take and keep and become more data driven as an investor. So if you're interested, scan the code. I'll leave it on screen for 5 seconds. All right. And that's it for me. I'm going to turn it back over to Jake. He's got a few things to go through, and then I will take questions. Jake? You're muted.
All right. Thank you. Thank you very much, Neal. So, yeah, that is the end of our presentation. Thank you all very much for showing up. But if you are interested in opening an IRA, if you're joining us for the first time today and not already an Entrust Group client, you can sign up for an SDIRA account on our website online at theentrustgroup.com. And the 3 steps to making an investment are to open an account by submitting an application, funding your account by transferring or rolling over from a previous IRA or making a contribution directly to your new Entrust Group IRA, and then direct us by filling out paperwork to purchase your investment. And we can go over that more if you have further questions about that. The Entrust Group does keep recordings of all of our webinars, including this one. So if you have any you want to see any of this information again, this will be up on our website very shortly, and you'll get a copy of the slides and a recording in our follow-up email afterwards. And then you can also register for our next month's webinar on another new topic of investment for self-directed IRAs. If you have any further questions or want to follow up and get more broad information about our investment opportunities or what you can do with an SDIRA, you can check out our Learning Center online at theentrustgroup.com and follow us on social media. And without further ado, we will get to the question and answer session. And I will address the topics that deal more with the logistical concerns for SDIRAs and with the Entrust Group, and I'll turn over the questions that have to do with the information presented by Neal to him. Just taking a quick look at our question and answer section here. We have a question that I think is going to be for you, Neal.
Sure.
Somebody asks, bonus depreciation is not permanent in the new bill?
No, bonus depreciation basically goes from, it was going to be 40% this year if the new bill had not been passed, which is okay, back up to 100% until the end of 2029, and then it starts to phase out just the way it was phasing out now. Remember, in the 2017 bill, I think you got 4 or 5 years at 100%, and then it went down 80, 60, 40, 20, and 0, and the same thing will happen starting 2030, where it'll go phase downwards.
And there we have it. And that is currently the only question in our Q&A section here.
Sure.
Looks like we had.
So I'll encourage people, if you want to ask about any other cities that were not in our list, we do we travel to cities all the time. So if there's any cities that you're interested in knowing about, in terms of real estate prospects, plug them in, just the name of the city, and I'll be happy to answer your questions about them if I know about them.
Ah, okay. Well, we've got questions about some specific cities here in response to that, Neal. What do you think of
Mhm.
Atlanta?
Terrific market. It's doing really well for a number of reasons. I tend to look at where the data centers are being built. Atlanta had 1 gigawatts of data centers that were built in the last 12 months. That's always a very good sign. In general, the city of Atlanta is doing well. Population growth is slowing, so that's a concern. At one point, it was one of the fastest growing cities in the US for net migration. That is slowing, but overall, its overall rate of in-migration is still superior to the average for the US. So a strong market and has seen a significant price declines for multifamily, not so much for single family. So I would say, yeah, strong market.
Very good. Now we've got somebody asking about Memphis.
There are 4 markets that we look at in Tennessee, and I would say Memphis is the weakest of them. So we like Nashville, we like Knoxville, we like Chattanooga. The problem with Memphis is very high crime and just continuous population loss, and that prevents us from recommending Memphis. I have to say there's plenty of good things going on in Memphis. I'm not blind to them. But overall, I just am very cautious about investing in markets that are high crime and have population loss.
Hmm. We have 2 people asking about Jacksonville. One of them specifies Jacksonville, Florida. I'm not sure if there's other Jacksonvilles, but we've got 2 people asking about Jacksonville.
Most times when people are talking about Jacksonville, they are talking about the one in Florida, so we'll assume that. What I can tell you is that Jacksonville's a very strong market, but is not in a good place right now. So we expect home prices to fall in Jacksonville over the next 12 months. We expect home prices to fall in all markets in Florida over the next 12 months because that's where the downward momentum is strongest. So what I would say is good market, but don't be in a hurry to jump in Jacksonville. Better prices are coming.
And how
And
about
then Austin. Yes. So in
mhm,
my mind, the only market in the U.S. that I consider to be stronger at this point in terms of momentum is Raleigh than Austin. But Austin has seen huge home price declines because it had the biggest, most aggressive run-up of home prices between that 2020 and 2022 timeframe, and now they're adjusting. I think that prices could still drop in Austin by 2 or 3%. So don't be in a hurry to buy.
okay. Hilton Head is the next question.
So South Carolina is a very interesting market. You just saw it ranked number one in the U-Haul rating. So there's obviously a lot of great things happening. I don't track Hilton Head as much as I track Myrtle Beach or some of the bigger markets. So it's an interesting market, but it's also challenging. So here's what I would say: Hilton Head, you got to spend some time with ChatGPT on that one.
San Antonio.
Same sort of issues. Austin and San Antonio are only 79 miles apart, so some of the downward drag that we are seeing in Austin is also happening in San Antonio. I would say I'm more bullish about San Antonio, but I would say there's just no harm in waiting 12 months. I like San Antonio a lot. I just don't think there's a harm in waiting.
Hmm. Atlantic City, New Jersey.
That particular market is very hard for data guys like me to track because of it's a gambling market and that those tend to mess up our numbers. So I'm simply going to say it's very difficult to compute what's happening in Atlantic City. So I'll pass on that.
Hmm. Paradise, Chico, California.
It's an interesting market. I wouldn't say it's the best market. You can probably do better by going into the Central Valley. You can do better in the Inland Empire than in Chico. So I'd say okay market, but I'm not really hard on it.
Hmm. Do we cover Houston or do we just do
We didn't.
Austin?
We didn't. So
Hmm.
yeah. So obviously 3 large markets. There's 4 large markets in Texas. There's Dallas, San Antonio, Austin, and Houston. Houston's a very large market. More than 5 million people live there. Right now, it's doing really poorly, and I think that's because it had a very large number of illegal migrants that have left. So until that stabilizes, I would stay away from Houston. Maybe stay away for the next 12 months and then see how it's doing.
Hmm. All right. Another New Jersey question here. Jersey City, New Jersey.
Um, It's pretty decent. I mean, as a market strong, there's nothing wrong with it. I just caution you. I think real estate investors don't understand just how outrageously absurd the property taxes are in New Jersey. Nobody does their math right, and then people go in there and then they realize they're not even breaking even. Please make sure you fully understand property tax math in New Jersey.
Hmm. Right. Going further south to Tennessee in Nashville and Knoxville, specifically the suburbs of Nashville and Knoxville, is
I
this
like
question.
Nashville, but there's no cash flow. So I would say if cash flow is really important to you, Knoxville is better. If you want higher quality of suburb, then Nashville is better. But I like both.
Hmm. Right. Next question asks, what about Dallas and San Antonio? We've covered San Antonio. What are your opinions on Dallas? We think we have
Dallas,
more
Dallas is the
insights.
number one metro in the US for growth. There is nothing that comes close to Dallas in terms of growth, its ability to absorb massive numbers of immigrants, not just immigrants, but just inbound migration from different parts of the US. It's the best market in the US. Raleigh has the most momentum, but Dallas is the best market in the US. It's just be aware that, right now there's just a flood of new apartments coming there, so you're not going to get good rent growth for 2 years. If you're a 10-year investor, I don't think you can find a market better than Dallas.
Hmm. Right. Next question is opinion of multifamily in Portland, Oregon.
There was too much of a run up in Portland, Oregon. I think that the market is soft, and I think it'll stay soft for the next year, so you might see more opportunity if you wait.
Hmm. Next question, do you foresee a relative big correction on the single family house market in Las Vegas?
Possibly, but not a big one, a small one. So, you might see a 5% correction in Vegas, but overall, Vegas's demographics, job growth are stunningly good. So you might see 5% down, but not more than that. And even that 5% is because there's a lot of immigrants fleeing.
Hmm. Next question asked about do you track Lake Tahoe, Nevada?
I don't track Lake Tahoe, but I'll say this, that the one of the markets that I'm obsessed with is Reno, Nevada, and I would say it's an incredible market. If you think about it, Lake Tahoe is not a market by itself. Lake Tahoe is, about 30 minutes away from Reno. It's part of the Reno MSA, the Reno Carson City MSA. That metro is one of the most unique in the United States. So I would simply say Tahoe is going to do well as long as stock markets keep rising. The big driver for Tahoe is very, very rich people that drive on Friday from the San Francisco Bay Area, all these VCs, all these startup people that have tens of millions or hundreds of millions of dollars, and they own or rent in Tahoe. And right now, the stock market's doing really well, especially tech stocks. So if that continues, Tahoe will do well. I can tell you that if the stock market goes down by 20%, you're not going to see Tahoe do well.
Hmm. Right. Going back across the country again, what do you think about Columbus, Ohio, and Charlotte, North Carolina?
I'd say Charlotte is much more of a growth market. Charlotte is the capital of North Carolina. It is the largest city in North Carolina, largest metro. I like Raleigh better than Charlotte, so I'll say that from a relative perspective. I'd much rather invest for a 10-year time frame in Raleigh than I will in Charlotte. But Charlotte is a high growth market. It's been very impressive. It's absorbed a very, very large amount of inventory that came in into the multifamily market. It absorbed all of it, did not, no change in rents. So it's a powerful market. Columbus is the best market in Ohio, but that's as far as I'm willing to go and say of the four markets that we track in Ohio, Columbus is significantly better than Cincinnati, way better than Cleveland, and a heck of a lot better than Dayton, Ohio.
Hmm. Coming back to the West Coast, Bookings, Oregon is the next
Too
question.
small of a market. We don't track markets of that size.
Hmm. And then finally, what are your opinion on opportunity zones, Neal?
It's actually good, but here's what I'll say, right? So the opportunity, part of the law was that opportunity zones are back, and I should have had a slide on that. It's actually better than before because opportunity zones before were a limited time thing. Now they basically just said they're back, right? But here's what I would say to you, right? Why are these opportunity zones? They're opportunity zones because their income is low, their growth is low, their crime is high, their schools are bad. There's a reason why an area is tagged as an opportunity zone. So what I will say is this of all the data driven things that you could do, the best money that you could spend is find sites, and there's sites out there, ask ChatGPT, it'll give you sites that rank opportunity zones in terms of qualities. Now, once you've picked one that's high quality, has basically momentum going forward from the opportunity zones bill, you're going to do really well. But otherwise, understand opportunity zones are opportunity zones because rents are low, quality of tenants is low, incomes are low, and often they're losing population. So be aware of what makes them opportunity zones.
Hmm. Right. We have another question, or really not much of a question here, but more of an observation that you might want to comment on here, Neal. It says the House version had bonus depreciation expiring in 2029. The Senate version has no expiration date. The Senate version is the final version. What's your answer to that?
In that case, you are correct because this deck was built using the House version because the bill had not passed on the day that this deck was built. So in that case, if the Senate version is the final version, you are correct. Opportunity zones are back. Period. Sorry. There is no expiration for bonus depreciation. Keep in mind that if the Democrats come back in 2028, then they'll, fiddle with it in 2029. So keep that in mind.
Okay, another person here. I have multiple beach condos. Does the rental market show selling and buying homes a better approach?
That's because I don't know where your beach condos are or what your appreciation is. That's an impossible question to answer. So I'll just simply say too little information.
Hmm. Next question. How do you measure the accuracy slash success of your prediction? Any data on that?
So what we used to do this manually, and it was a painful thing to do, where we would basically make predictions on where various metros would go at the beginning of the year. At the end of the year, we would manually tally it up. We no longer need to do that. We use an AI engine that we've developed ourselves. We'd say we're we're right about 75% of the time on metros and wrong about 25% of the time. I don't particularly know if that's good or bad. I would just simply say it's better than 50%.
Hmm. Okay, the previous person who asked about their condos clarifies condos are in Miami and Atlantic City.
My honest answer is that the Miami market is not going to be good for condos for a long time. So if you're getting a good price, get out. Atlantic City is very variable. It's a gambling market, so I wouldn't comment on it. But I am not at all hot on the future of condos in Miami. They have been hit with something that is a multi-decade correction. I'm sure you've heard of it. After the collapse of that condo building, we are seeing outrageous, increases in the condo fees. I don't think that that is going to reverse,
Hmm.
at least not for the next 5 or 10 years.
All right, new question. In general, what do you think is the sweet spot in terms of number of dwelling units in a senior development community?
The honest answer is the sweet spot is either 5 or 6 units in a single family home. Those are very profitable. They fill up really easily. They're not high density. If you're going beyond that 5 or 6 in a single family home and you're building something bigger, I would definitely go for 125 units. And that may not work for you in terms of, the equity you have available. But you asked the question, so the answer is either I'd go for 5 in a single family home or I'd go for 125 along with memory care. So you don't just want to have seniors in there. You want to have some memory care. Memory care is more profitable. All right.
All right, any
Looks like
further
we're done with all of
questions?
them.
It appears so. Well, thank you very much, everybody, for the questions. Thank you, Neal, very much for all of the answers and all of the incredible information you provided to us today. Anybody who would like to get in touch with myself or Neal, our contact information is available on this last slide. Please feel free to give us a call or send us an email with more questions, or if you want to follow up this webinar today.
Well, thank you, Entrust folks, for allowing me to do the webinar again. Enjoyed it. And everyone that's interested in our projects, please connect with us via the poll or via the barcode that we provided.
Mm.
Thank you, Jake. Thanks so
Thank you,
much.
Neal.